If you are a salaried employee in India and your company gives you meal vouchers, gifts, loans, or a car, listen up. The Central Board of Direct Taxes under the Ministry of Finance released the Draft Income Tax Rules 2026 on 7th February. This will change how these extra benefits are taxed starting April 2026. Some changes mean you may pay a bit more tax, others actually give you more tax relief. Today we'll explain what these perks are, what's changing, why it's happening, and what it means for your take-home pay. Let's begin. What are perquisites? Your salary isn't just the money that hits your bank account. Company often gives you extra benefit on top of it. These are called perquisites or simply perks. Think of them as non-cash goodies that make your job better. A company car you can use for personal trips, free or cheap meals, meal vouchers, low interest or interest-free loans, rent-free homes or subsidized housing, gifts on festivals or on achievements, use of company laptop, club membership, you name it. These perks have real value. So the income tax department says this is part of your total compensation. They assign a rupee value to the perk and add it to your taxable income. That's called perquisite valuation. Simple reason, fairness. If perks weren't taxed, companies could give everyone fancy cars, houses instead of salary, and no one would pay tax on it. Assigning a value to these perks and putting a tax liability on them keeps things balanced. Not everything is taxed though. Small benefits often have tax-free limits. Now, here's what's new in the draft rules released this month. The old limits hadn't been updated for decades. The new draft rules intend to change that and put everything in tabular form for easier understanding. Here are the biggest updates. This is the one that will hurt the most as it comes with a big increase in taxable value. If your employer provides a car for both official and personal use, this will impact you. If your company gives you a small car that has a 1.6 liter engine or smaller, the taxable value jumps to 5,000 per month from 2,700. For bigger cars with more than 1.6 liter engines, taxable value is now 7,000 rupees per month as opposed to 3,300. If your company also provides you a driver, the taxable income for that perk is rupees 3,000 per month, which was earlier 900 rupees. This is about a 3 times increase. Why? Because cars, fuel, maintenance cost are way more today. So more of the car's value will be added to your salary and appropriately taxed. If you are in the early stages of your career, you need not worry, as it is extremely rare for the entry-level employees to get a car from the company. The mid or senior level employees will feel the pinch the most. This is good news for most employees who get meal passes or subsidized meals from the company. The tax-free limit for office meals or food vouchers during work hours has been quadrupled. Now 200 rupees per meal is completely tax-free. This was only 50 rupees per meal previously. This finally matches today's food prices. If your company provides lunch or meal cards, a big portion will escape tax. This applies for festival gifts, achievement awards, vouchers, and any form of gift your company provides. Annual tax-free limit for gifts from the employer has been increased from Rs 5,000 to Rs 15,000, triple the previous limit. Employers can now give more expensive gifts without triggering more tax for you. If you take a small personal loan from your company, this one is for you. Loans up to 2 lakh will have zero taxable perquisite value. Previously, this limit was only 20,000. This is a huge 10 times jump. Makes small loans from employer far more attractive tax-wise. Another important perk is company-provided housing or rent-free accommodation. The new rules have actually made this a bit more tax-friendly. In big cities, the taxable value is now 10% of your salary, down from 15% earlier. Government has also added an inflation cap, so the tax doesn't keep rising every year if you stay in the same house. This is good news for employees living in housing given by the employer. Besides these, the new draft also updates valuation rules for several other common perks. Domestic help such as sweeper, gardener, or watchman paid for by the company. Free or subsidized gas, electricity, and water. Children's education facilities or school fees, holiday tours and travel expenses paid by the employer, club membership fees, usage of company furniture, AC, fridge, etc. Most of these continue with minor updates for clarity. These limits were seen as being stuck in the past and that they did not reflect today's scenario. The government is now updating them to reflect inflation and real-world costs, making rules clearer and more transparent with proper tables, aiming to reduce confusion and disputes between companies and tax officers. Overall, it's a recalibration to match the economic reality of 2026. There are also some related changes from earlier updates, raising the salary thresholds for when perquisites start applying in detail. Lower income employees, especially below the 4 to 8 lakh salary range, may see fewer perks becoming taxable. This helps balancing things out.
The CTC or the cost to company for the particular employee will also be affected. And at the same time, that will add more money under the taxable value. So it may not be very good for the employee as the valuation of various perquisite. If it is on the higher side, that means under the CTC, that amount has to be provided. From the employee value, rise in the perquisite taxation may not be a good thing. At the same time, some of the perquisite, you can call it as the HRA or compensatory city allowances. If there is increase in that, that means more money in the hand of the people. So that is other thing. So when you talk about perquisite or the benefit, you have to consider two things. One, which is the goods or non-cash, and the other one is the cash. So in terms of cash, it will go up. In terms of goods, the value will add to the taxable amount of that employee. And in that situation, the tax implication may be on a higher side for the employee. At this moment, when the companies are structuring the CTC, they keep everything from the taxable point of view as well as from the how much money is going directly into the pocket, what we call as the carry home salary or the net salary thing. So company can do that if they can raise the basic salary structure, basic plus HR, basic plus DA, that will also help. So if they are providing some kind of perquisite, if they keep that value lower, that will help that. Because see, there is no mandatory condition on the company per se to keep this value only. This is the limit which they can apply. So you can keep the limit low and accordingly you can provide the tax benefit. So that is one option for the companies to go for that. In terms of the cash part, if they are providing some cash, that means they can add that into their business expenses and there they will get the tax benefit. So I think the companies will have to restructure the CTC, keeping in mind the taxable implication after the rise in the value of various perquisites. And certainly they will try to find out some ways where there's not much tax burden on the employee per se.
The draft is open for public suggestions until 22nd February. After that, the final rules will be notified. These changes are expected to kick in from 1st April 2026 along with the new Income Tax Act 2025. Thank you for watching. Stay tuned with the Hindu Business Line for more updates.